Well, hello everyone, and thank you for joining me this afternoon. Before we dive into our presentation, let's warm up with a little tax brain teaser about Bill. Sounds like fun now, doesn't it? So, after working hard his entire adult life, Bill, 65, has finally retired, and he's attending more concerts than ever before. Bill has $48,538 in taxable income, which includes $37,500 in Social Security benefits each year. As you can see, Bill's 48,538 of taxable income puts him in the 22% tax bracket because it's, well, more than $48,467 and less than $103,350. Towards the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to go see Willie Nelson play in Austin, Texas. How much is he taxed on that extra $1,000? Well, the logical answer is that for every dollar of IRA money he pulls out, he pays 22 cents in federal income tax. Therefore, if he took out $1,000, he should pay about $20 in federal income tax, or 22%. Simple enough, right? Wrong. He owes $407 in tax. That's a 40.7% federal tax on income. Thanks to the madness that is our tax code and the unique formula that determines how Social Security benefits are taxed. Welcome to our presentation, 4 retirement tax surprises and how to avoid them. My name is Tim Gardner, and I'm a wealth manager and a founder of Chatham Wealth Management. Thank you for joining to learn more about taxes and retirement, and I want you to be assured that one thing about this presentation, I believe you'll be better informed about the challenges of retirement tax planning after you listen to this talk. Now, you're probably wondering, why is Tim giving a presentation about retirement tax planning? Well, occasionally I give workshops and classes on various financial education topics such as Social Security, IRA planning, late-stage college funding, and the like. My goal is always to inform and educate my audience so you can understand how critical financial planning topics affect you and your family. I'm doing this presentation because I've seen many people make mistakes and pay more taxes in retirement than necessary. And when that happens, that actually makes my job a lot harder because people have less income in retirement, and we have to find ways to make their portfolios last longer. Taxes seem complex and jargon-filled, even though the underlying concepts are relatively straightforward. Let me briefly explain how this workshop will unfold. Presentation is organized into 4 keys. Each key builds upon the previous one to form a solution to our presentation problem, as you'll see. To help you remember what we're covering here today, I've put a link to the How Tax Planning Changes During Stages of Retirement handout, which summarizes our presentation. That can be found down in the chat or down in the description, depending upon if you're catching this on the replay. Now, you may have questions as we go along, and I always want to respect people's time. So I won't take any questions during the presentation to ensure we get out of here on time. But I will take questions at the end and gladly talk with you about your specific situation. And if you want, I've also put in the chat my calendar, so if you want to speak directly afterwards. At the end of the presentation, I'll invite you to a taxes and retirement planning overview meeting. I offer this complimentary one-on-one meeting so we can discuss the issues raised by this presentation in private. I'll tell you more about that one later. Please be sure this is not a sales presentation. You will hear nothing remotely close to a sales pitch out of me. But now, there's one more thing I need to point out. Everyone's tax situation is different. You should always consult a qualified tax professional to discuss your specific situation, especially about these topics. Traditional IRAs, they're tax deferred. You must pay taxes on the distributions or conversions at ordinary federal and state rates. Roth IRAs, they're non-deductible. Money grows tax-free, and earnings may be withdrawn tax-free according to IRS rules. This presentation references federal taxes only. You may still face state taxes. Check with your tax professional. Now, for those of you who don't know, I am a wealth manager. As I said earlier, I do not provide tax advice, although I do provide tax education. I help people understand the tax code and other rules that could impact their financial planning and investments. And then we develop a plan to consider the many odd situations that you'll encounter in retirement, especially around taxes. We aim to help you understand that the retirement distribution game, spending assets in retirement, differs significantly from the accumulation game when saving for retirement. Chances are you've been in the accumulation phase of your life for the last several decades. Been working hard, trying to save money, and hopefully your accounts have grown. Now, as you enter or prepare to enter retirement, you are in an entirely different phase, the distribution phase. And the distribution phase has new and strange rules that can catch people off guard. And along with those rules, there are often many changes in your life that can significantly impact your taxes as well. For instance, your children are grown, meaning no more child tax credits. Your house may be fully paid for, meaning no more mortgage interest deductions. You may no longer receive tax-free employer-paid medical insurance if you're retired. If you stop working, you may no longer be able to stash income into a 401k or similar plan to manage your annual tax bill. At some point, you'll start taking Social Security, and shortly after that, when you reach 73, you'll have to start taking required minimum distributions from your retirement accounts. The list of changes goes on, and many aspects of retirement will affect your tax bill differently from your working years. Understanding what these are and how they will impact you is crucial. So this brings us to our simple statement about the problem we are here to discuss. Simply put, people often pay more taxes in retirement than expected because of a confusing system that treats various income types differently and contains hidden taxes and penalties. In the accumulation phase, people build their assets in various forms of stocks, bonds, real estate, pensions, IRAs, 401ks, and more. In the distribution phase, your regular wages earned income stops coming in, and you have to take the money you've saved and use it to fund your retirement, which can go on for decades with good health on your side. That's challenging because you'll need to make informed decisions about the tax implications of tapping different accounts, which can be costly. In retirement, your tax rate can vary dramatically on your choices, such as the timing and the order of which you use different sources of money to pay for your expenses. Poor choices caused by misunderstanding or ignorance of the rules can result in many people paying more taxes than necessary, and as a result, they may see their savings drop faster, which can mean less to leave for the kids and grandkids. Of course, we don't want that for you. Your presence here means that you are willing to work towards a solution, which is essential in our first step. Because your tax exposure will change throughout the 4 stages of retirement, you'll need a strategy that anticipates both traditional taxes and possible taxes, surcharge, and penalties related to Social Security and Medicare. This means you'll need an informed and proactive plan to address how you create your income in retirement. Aim to introduce you to significant aspects of this strategy, show you the challenges we face, and then explain what makes a workable solution for your retirement tax problem. The first step is to understand what types of taxes you may face. What do I mean by taxes? I'm talking about all the costs that can increase as your income does, including some that aren't called taxes. If your costs increase as your income rises, it's a tax in my book. We also need to understand the retirement expenses you'll face. You'll need to create a strategy to help you decide which access to tap first, how much you should take from those assets, and when those distributions should occur. Getting this right can help you pay as low a tax rate as possible. Before we go on, here are the 4 stages of retirement we'll discuss. These are rough ranges and descriptions. Your experience may differ, but this is just a framework for our discussion of the topic. First, the pre-retirement or work and save phase, usually years 50 to 60. Next are the early retirement years, the 60 to 70 or go-go years. People often have grand plans for travel, volunteering, starting new hobbies, working part-time, or spending more time with their families. Next, they'll reach their middle years of retirement, 70 to 80. These tend to be the slow-go years, which bring more financial decisions, such as how to deal with required minimum distributions from your IRAs and other retirement accounts. And finally, they're the later years in retirement, where your health may not be as good and you're thinking about your legacy and estate. These tend to be, sadly, the no-go years, which start around 80. As you'll see, each phase must address a wide range of issues, and this can be much harder than it seems because retirement is full of surprises, and even the best planning can divert from reality at some point. One future unknown is inflation. People view their future costs in current dollars and don't always anticipate how they'll grow with inflation. Think back 30 years ago. The cost of a gallon of milk, a gallon of gas, I won't mention eggs, a trip to the emergency room. Now think what those costs today and what they'll grow to over the next 30 years when you're not working. That's inflation. How long do you think you're going to live? Many people also underestimate how much they'll need to maintain their pre-retirement standard of living. Who wants to see their standard of living drop? And then there are healthcare costs. That's the 10,000-pound gorilla in the room. That includes your out-of-pocket payments for services and drugs, plus Medicare and insurance costs, which keep rising. At this point, you're probably beginning to think, okay, so what's the first thing I need to understand about retirement and taxes? Well, this brings us to our first key. You must know your after-tax retirement savings picture before retiring. Because a $500,000 401k or IRA balance isn't $500,000. The government claims part of that money because the taxes were deferred. They'll get their share when you're forced to start your required minimum distributions. Now, the Secure Act 2.0 has pushed back RMDs to 73 if you were born between 1951 and 59. And if you were born after that, you won't have to start taking your RMDs until you turn 75. Now, obviously, the higher your tax rate retirement, the less your account is worth. Here's an example. This chart shows the cumulative after-tax amounts you could expect to receive from a $500,000 IRA earning 6% per year at various tax rates. As you can see, the lower the tax rate, the more you keep. Simple in theory, but very complex in practice. This presentation applies to pre-retirees and retirees, so don't worry if you've already started your retirement. Tax planning is essential throughout retirement. You may be thinking, okay, my accounts may not be worth as much as I thought, but I'll still have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my health costs. But one thing you must understand when creating a retirement plan is Social Security and Medicare have their own tax traps to plan for. Let's go back to our good friend Bill from our brain teaser. We want to understand why he paid such a high tax rate on the extra money he took out of his IRA to go on a road trip. Now, remember, Bill has $40,000 in IRA income, part of his adjusted gross income of $65,538. He also has $37,500 in Social Security benefits, which puts him, as we discussed, squarely in the 22% tax bracket, and he takes the standard deduction. Yet when he took the extra $1,000 IRA distribution, he got hit with nearly a 41% marginal tax rate, or $407 on that $1,000. Let's break it down to see how this happens. First, let's remember that the difference between our two scenarios here is that Bill has taken an additional $1,000 from his IRA. You can see that in the after concert trip column. He has $41,000 in IRA income. So, as you can see here, we're adding an additional $1,000 of actual income and increased his AGI and taxable income by $1,850. That means that he's going to be taxed $1 for every dollar of income he receives. How does that happen? Here's the deal. The amount of your taxable Social Security benefits varies depending upon your other income. For instance, if your other income is low enough, all your Social Security benefits will be income tax-free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at your rate. Bill finds himself in the latter scenario. At his current income, after the trip, for every dollar he takes out of his IRA, he not only adds $1 of his IRA money to his taxable income, but he also must add 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% tax rate for every dollar of additional IRA income he receives. If you do the math, that comes to a 40.7% real tax rate on the extra income. That's what's called the Social Security tax torpedo, and it can impact single filers and married couples, even reasonably modest incomes during any retirement stage. It's one reason planning taxes in retirement is so essential. Let's take a look at another aspect of Social Security and taxation and how people approach retirement. Now, during the go-go years, some people retire together, but others enter at into semi-retirement. Sometimes it's a continuation of a previous job with fewer hours. Others use semi-retirement to explore an interest or a new field. Still others use semi-retirement to pursue non-paid rewarding volunteer work. So, working in retirement can impact your planning and taxes in several ways: good, bad, and in some cases just downright ugly. Let's take a look at how working in your retirement years can be good. Chances are you have researched what your Social Security benefit will be at various stages. However, you may not know your Social Security benefit is calculated using the highest 35 years of inflation-adjusted earnings. Well, what if you started working late in life? Or what if you left work to raise a child? You may not have 35 years of earnings history. Suppose you have only 28. Those 7 years count as significant fat zeros when calculating your benefits. But there's other good news. Earnings at any age can help increase your Social Security benefit. And thanks to how Social Security calculates your benefits, replacing several years of zeros with even modest earnings can positively impact your benefits. Now let's take a look at how working during your go-go years can be somewhat alarming if you're already collecting benefits and unaware of Social Security earnings limits that apply before reaching your full retirement age. Here's how it works. If you start Social Security, your retirement or spousal benefits before you reach full retirement age, for every $2 above a certain amount, you earn $23,400 for this year, 2025. Social Security will withhold $1 of benefits. Remember, we're talking about earnings here, like W-2 salary or self-employed income, not pensions, interest, dividends, capital gains, or anything like that. They don't count and won't reduce early Social Security benefits. For instance, let's say you earn $25,400 in 2025. That's $2,000 over the limit. Therefore, under the $1 withheld for $2 in earnings rule, Social Security would withhold $1,000 of your 2025 benefits. But these benefits are not truly lost. When you turn full retirement age, your benefit will be adjusted to make it appear that you had applied at full retirement age concerning those withheld benefits. In other words, your benefit going forward will be a bit higher. Also, in the year you reach full retirement age, there's a separate higher earnings test. Okay, we've discussed the good, seen the bad, so now we'll hear about the ugly. We're here today to talk about taxes and retirement, but there are other taxes that you need to face too. For instance, you're subject to a 7.65 Social Security and Medicare taxes and income tax while working. The self-employed pay twice that amount, or 15.3, to cover their employer's contribution. These taxes don't go away if you're working past full retirement age or even collecting Social Security. Worse, if your go-go year's earnings don't make it into the top 35 years, your Social Security taxes go into the trust fund and don't increase your benefits. Now let's examine how Medicare and what it calls IRMA, IRMAA, can impact couples in their go-go years and beyond. First, what is IRMA? It stands for the Income-Related Monthly Adjustment Amount. The emphasis is on income because it is a monthly tiered surcharge, again, a tax, tacked on to people's Medicare Parts B and D. But it only happens if your income is over $106,000 for single filers and $212,000 for married couples filing a joint return. Let's take a look at what this means in action. Let's meet Georgia and Marcia. They are a high-earning married couple who are both Medicare B and D participants. IRMA surcharges affect income from 2 years prior, and this couple was on track for $334,000 of a modified adjusted gross income, or MAGI, in 2023. But on December 1st of 23, George decided to sell a stock he bought for $10,000 on July 1st of 2007. He sold the stock for $11,000, resulting in a $1,000 gain, which was taxed at 15% long-term capital gains rates, plus an additional 3.8 net investment income surtax for a total federal tax bill of 18.8. That 3.8 net investment income surtax is another tax that comes into play when your MAGI exceeds $200,000 for singles and $250,000 for married couples. So George and Marcia owed $188 in tax on the gain from the sale of their stock, correct? Or 18% of $1,000, or do they? Remember, my definition of a tax is any cost that increases as your income increases. So George and Marcia will owe more tax than just the $188 because the gain on the sale of the stock pushed them off the IRMA cliff and into paying higher Medicare premiums. Let's take a look. Look at the Part B IRMA chart. That extra $1,000 gain pushed their adjusted gross income into the next premium tier that starts at $334,001. So instead of owing $307 each for their monthly Medicare Part B premiums, George and Martha owe $408.90 per month, an extra $110 per month, times two, $221 for a total annual additional income-related monthly adjusted Medicare premium Part B of $2,661.60. But it's not over yet, because Part D IRMA charges are also impacted. George and Marcia will pay an additional $21.70 for their drug plan, or an extra $520.80 for the year for the couple. Adding all the IRMA surcharges together for the year, George and Marcia will each owe an extra $132.60 per month, or more than $3,000 of combined additional charges for the year. Combine that amount with $188 of actual federal tax that they would owe on their stock sale, and the total tax on a $1,000 gain comes to $3,370.40. That's a tax rate of 300%. Let me repeat that one more time. That is a tax rate of 337%. Let's take a quick review. They sold the stock for a $1,000 gain. The stock sale tax was $188, 15% long-term gains, and 3.8% in net investment income tax for higher earners, getting us to an 18.8% rate. The extra income from the stock sale triggers new IRMA tiers. The total IRMA surcharges amount for the year to $3,182.40 for George and Martha. So that $1,000 of extra income triggers taxes of $3,370.40. Again, a 330% rate of taxes. You see, being pushed into a higher Medicare B and D premium range is worse than being pushed into a higher tax bracket. That's because if you exceed the regular tax bracket by even a single dollar, only the last dollars are taxed at the highest rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move into the next premium tier. It doesn't matter if you exceed it by $1 or 10,000. That's why it's called the IRMA cliff. Remember, your IRMA payments aren't determined by how much money you made last year, but by your MAGI from 2 years ago. It's another tax thing that catches people by surprise and needs to be planned for. Ensuring you enroll in Medicare at the right time is a critical decision. If you bungle it, you'll get hit by a lifelong penalty. To help you understand, meet Jim and Ann, both 68. Jim retired at 65, Ann retired at 66. Before retirement, the couple had health insurance through Ann's employer, which they continued after retirement because the employer offered retiree health benefits. Unfortunately, they didn't know they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offers retiree health insurance benefits, those are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize that mistake until it was too late. Thanks to the way that Medicare enrollment periods work, they couldn't begin coverage until the next year. In a worst-case scenario, that might have resulted in a gap in coverage for both Jim and Ann if they had a significant medical need. But even in a best-case scenario, because Jim and Ann missed their deadline to sign up for Part B, they will each owe a 10% Medicare Part B base premium penalty for life. You can see how much that translates into real dollars. They owe $444 extra in 2025. Premiums will be higher, so that a 10% penalty will grow and grow. Throughout a lifetime, that could translate into a $10,000 mistake for this couple. For simplicity's sake, we're assuming that Ann's retiree health insurance covers prescription drugs, so they don't have to sign up for Part D. Just know there's a penalty for that one too. We've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So, if you're like some who've seen this presentation before, you're probably asking yourself, are there any other tax traps I'm going to face in retirement? Well, the rest of what we'll cover, like what we've seen with the Social Security tax torpedo or the Medicare IRMA cliff. The public generally isn't aware of those tax squeezes. We'll see how the tax code in plain view snags retirees, especially when there's no planning. And this brings us to our third key. You must plan how and when to use taxable, tax-deferred, and tax-free assets to efficiently manage your income and tax brackets. You can't be haphazardly tapping into your tax-deferred savings. Timing is everything, and if you don't plan carefully, you'll encounter unintended tax consequences throughout all the retirement stages. Let's look at this by addressing a question I often get doing retirement income planning. Which accounts should I spend first? Here's a typical example of Sam and Mary. As you see here, they've been good savers and look forward to spending their retirement years traveling and seeing their grandkids. In addition to Social Security benefits, they have $450,000 each in IRA, $60,000 each in a Roth IRA, and $300,000 in a joint bank account. They want to spend about $8,500 a month for just over $100,000 a year. Where should they take their money from first? Most people think take the after-tax money in the bank, then the tax-deferred, and then take the tax-free Roth IRA money. This is conventional wisdom. Many big investment firms have promoted this for some time. It's not an evil plan, but conventional wisdom isn't always the best approach. Surprisingly, the topic has drawn attention of academic researchers specializing in financial planning, and they've conducted multiple studies on preparing for retirement using a combination of Social Security, taxable bank accounts, tax-deferred accounts like IRAs and pensions, and tax-exempt Roth accounts. You can see some study titles here. Their research has shown that the conventional wisdom approach probably isn't ideal. In an alternative approach, there are two key elements in the early years. First, use the taxable bank money for expenses. During the same period, accelerate your IRA distributions during otherwise low-income years, putting the money into a Roth account. This is the filling the tax bracket approach, which we'll discuss here in a second. This alternative approach allows you to use tax-free Roth money strategically in future years. So, does this make a big difference? I think so. Academic studies have shown that this approach increases portfolio longevity. That is, the time your portfolio assets will last without requiring you to take additional risk. The big takeaway here is that you have to plan for retirement, especially regarding how you'll handle tax-deferred assets. And of course, you're going to need to see your tax professional for tax advice on this. One way to help manage your income before and during retirement is to utilize Roth conversions. A Roth conversion is a simple process that allows you to move money from an IRA or another pre-tax retirement account like a 401k to a Roth IRA. The amount you convert is added to your annual income and you'll be taxed at your rate. For example, Jill converts $100,000 from her IRA to a Roth. She must add $100,000 to her income. The conversion income will be taxed at Jill's rate. For that reason, it's recommended you consult with your tax professional before making any decision like this. A conversion doesn't need to be all or nothing, though. One helpful conversion approach is called filling up the bracket. Often, you may find yourself in the middle of one tax bracket with room to add more income without pushing you into a higher bracket. For example, in 2025, the 22% tax bracket for married couples filing a joint return goes from about $96,950 to just over $206,000. If you file a joint return and your taxable income is $110,000, you could add another $95,000 without entering into the next bracket, making a Roth conversion like that make a lot of sense. If you plan to convert a large IRA, this approach is often more tax efficient than a full amount in 1 year. Instead, you make smaller Roth conversions over several years, filling up your bracket each time. You'll pay on your converted money and spread the tax bill over a more extended period of time. Roth IRA conversions can be especially powerful when one's taxable income is low, such as when one has high non-recurring medical expense deductions or a low sales year for a business owner. It's common for people who retire early and are not receiving Social Security benefits or pensions or IRA distributions. They may be in a very low tax bracket, making it a good time to complete a Roth IRA conversion in those pre-RMD gap years. So this is a good time to spell out the crux of things. You must know whether you're trying to keep your income below a bracket threshold to avoid bumping up into the next highest tax rate, or whether you're trying to increase income to fill a bracket to take advantage of that tax rate. Some tactics you could use in managing around tax brackets might include withdrawing tax-free money from life insurance policies to keep income low, selling highly appreciated stock for low or no capital gains, making distributions from IRAs or 401ks to take advantage of lower tax rates. As we've seen, you can also consider partial Roth conversions to fill your lower tax brackets. There are also two other pre-retirement strategies to consider, but these aren't for everyone. First concerns using a health savings account. This applies to people who are covered by a high deductible health plan or HDHP. The second concerns small business owners. Those who want to be extra tech savvy and saving for retirement can fund a company pension plan, which for high owning business owners can increase their ability to claim a qualified business income or QBI deduction. Both of these tax code features could help you manage your tax exposure and provide significant tax-favored benefits throughout retirement. If either or both of these apply to you, note that now. We can discuss it later on. Throughout our presentation, we've seen the importance of managing tax-deferred accounts, because at some point you'll be forced to start taking out required minimum distributions or RMD, and that can be troublesome to free a tax bill. However, many people donate to their favorite nonprofit with annual gifts. So let's look at how RMDs and charitable giving may work for you in some tax planning. Albert and Shirley. They're in a 24% tax bracket. The standard deduction for the married couple filing a joint return in 2025 is $30,000. But Albert and Shirley are over 65, so they get an additional standard deduction, bringing their total standard deduction for 2025 to roughly $33,100. This means they will receive no tax benefit from any itemized deductions unless their total exceeds $33,200. So, if Albert and Shirley have $15,000 in existing itemized deductions, say from state and local taxes, deductible medical expenses, what happens tax-wise if they donate $5,000 to their charity? They get no federal tax benefit from making a charitable contribution because it doesn't exceed the $33,200 deduction. That's not to say they shouldn't do it, but they should understand that doesn't help them save on taxes. Now, if you're over 70 and a half and you have an IRA or an inherited IRA, there's another way to give to charity than simply writing a check. It's called a qualified charitable distribution, or QCD for short. Let me explain how it works so you can see why a QCD is so powerful. First, some rules. If you're 70 and a half or older, you can make a qualified charitable contribution of up to $100,000 yearly from your IRA. If you're married, both of you are over 70 and a half, and both have IRAs, you can make up to a $100,000 qualified charitable contribution from your own IRA. Second, any qualified charitable distributions you make count towards satisfying your required minimum distribution for that year, which begins at age 72. However, when you make the distribution from your IRA, it must go directly from your IRA to a qualified charity, or you can receive the check from your IRA custodian made payable to that charity. Third, this is the odd part. Even though you gave it to charity, you do not get an income tax deduction. So, Why would I suggest a strategy where you get no deduction for giving to charity? Because when you make a qualified charitable distribution, the distribution from the IRA is never counted as income when the couple does their taxes. Let's see how this helps Albert and Shirley. First, suppose Albert and Shirley do what many retirees do. Albert takes his RMD of $5,000 at the beginning of the year and deposits into the bank. He's done with his RMD for the year. Now, being a charitable person, they donate $5,000 to a charity. The charity receives their $5,000. Everybody understands that, right? But let's look a little more closely. By giving to charity this way, Albert and Shirley's $5,000 contribution will cost them $6,200. Well, why? Because the $5,000 RMD that went into Albert's checking account at the beginning of the year still has a tax cost. Remember, the couple is in the 24% tax bracket. 24% times 5,000 equals 1,200. So the 1,200 additional tax Albert and Shirley must pay when they file their taxes means the total cost of the charitable gift was 5,000 plus 1,200 or 6,200. Remember, the gift didn't impact their standard deduction. The RMD behind it was just added to their income. See what happens if Albert and Shirley use the QCD to donate $5,000 to charity. Now, instead of requesting a $5,000 distribution from his IRA to go to a bank, Albert would simply have his custodian transfer the $5,000 RMD directly from his IRA to the charity. This satisfies Albert's yearly RMD because he's over 73. The charity is in the same position as it was before. They receive their $5,000 donation, which is a good day. Albert and Shirley, however, are in a better position. They still gave their $5,000 to charity. Even though they receive no tax deduction for making the contribution, their IRA distribution is excluded from their tax return. Therefore, they owe no more taxes on the $5,000 distribution. Their total cost to give the $5,000 to charity is $5,000, a $1,200 savings over the previous example, simply by knowing how to use the tax rules to their advantage. And they did all that without even getting a deduction. We all know charity starts at home, so it's a natural question. How does retirement tax planning figure in? It's an excellent question because the government still wants their share of those tax-deferred assets when you pass away. As we've seen, how you set up things matters. This leads us to our final key, number 4. Organizing your assets for your family's benefits. Yes, estate planning still matters. Even though people dislike discussing death, estate planning is always a relevant topic. But we're not going to be discussing it traditionally. That's because the new tax law excludes estates valued at up to $13.6 million from federal estate tax, meaning only the tiniest fraction of people need to worry about estate taxes. Note, you may still have estate and inheritance taxes on the state level, but again, we're dealing with only federal law right now. Still, it's a very important tax issue, remains around how your beneficiaries receive your estate after you die. One example is ensuring married couples plan for their available step-up basis. Simply put, a step-up in basis is a tax rule that readjusts the value of an inherited asset so that its value is not what your spouse or decedent paid for it initially. Instead, it's stepped up to the price on the date of death. This can make a big difference, as we'll see. It's likely that most of your assets, other than your retirement accounts or annuities, will be periodically eligible for a step-up. Consider Phil and Mary, who live in a separate property state. They're married and own various taxable investments in a joint account, known as the Joint Tenants with Rights of Survivorship account. And their investments have long-term capital gains of $120,000. One day, bad news arrives. Phil is diagnosed with terminal cancer and he has 18 months to live. Let's see how this works with two scenarios. In the first, Phil and Mary do not make any planning changes to their assets. Mary receives a $60,000 step-up when Phil dies based on Phil's half of the joint account. However, she'll still face a future $60,000 unrealized gain on her half of the account. Simply put, If Mary decides to sell her assets, she's going to owe $60,000 in capital gains. Suppose Phil and Mary moved all their investments into one account in Phil's name upon his diagnosis. Then, as long as Phil lived longer than a year, Mary would receive the full step-up based on the $120,000 account. Simply put, Mary could sell that account and pay no tax. When you sell your investments, would you rather owe tax on $60,000 of gain or none? And let me say, planning around death is hard, but this is where a professional can help because they are emotionally removed from the situation and can assist you with making good decisions that may seem complicated. Maybe you've saved up quite a bit in your IRA or your 401k, and you feel pretty confident you'll be comfortable in retirement and hope that you'll leave your account to your children. In the past, we'd recommend that because with proper structure, your heir could withdraw the money throughout their lifetime, possibly decades. That changed with the passage of the Secure Act in December of 2019. Now beneficiaries of inherited IRAs, with some exceptions, must withdraw all the money within 10 years of the owner's death and pay taxes on that money. This restriction on what's called the stretch IRA shines a light on how vital tax planning is. Laws can change at any time, so we need to have a plan that revisits them regularly. Let's look at Pamela and Kyle as examples of choices beneficiaries have when they inherit IRAs. They can no longer stretch the distributions over their lifetime. In the first scenario we have involves Pamela and her son Kyle. Pamela unfortunately passes away, leaving her entire IRA to her son Kyle. He's the only child and the sole beneficiary of her IRA. Now, Kyle has 10 years to withdraw the IRA monies to meet the new minimum distribution rates. Kyle likes regular distributions and has taken equal distributions of the funds over 10 years. The IRA earns an average of 6% annually. This payment would be $54,347 to Kyle each year over 10 years, which he would have to add to his income tax for the next 10 years. The second scenario is for Kyle. Looks a little different. He lost track of time and reached year 10 of the required minimum distribution window. Since it's year 10, he must take out the full distribution in 1 year, assuming the same 6% rate of return is earned annually on the $400,000 IRA. We can calculate the IRA balance has grown to $716,339. Kyle must take the full $716,339 as a distribution in year 10 and pay income tax. In year 10, Kyle will be at the top income tax bracket. Okay, enough about death. Let's talk about long-term care. This is not a long-term care presentation. It's about retirement and taxes. Believe it or not, several tax breaks are associated with long-term care insurance. Long-term care premiums may be deductible medical expenses at the federal level and possibly eligible for deductions and credits at the state level as well. On the other hand, if you're receiving long-term care benefits, those benefits are tax-free in many cases. For instance, benefits received from a reimbursement-style policy are tax-free. In addition, cash benefit-style policies are tax-free if you don't exceed the higher of your actual long-term care costs or the IRS daily limit, which is currently $410. Choosing how you pay for long-term care costs can significantly impact your estate and your heirs. In recent years, non-traditional long-term care policies that combine both long-term care insurance and life insurance have become extremely popular. Often, the insured's first inclination is to tap into the policy to pay for the long-term care, but it's often a mistake. Let's look at Florence, a widowed woman who qualifies for long-term care benefits and lives at home with in-home care. Her yearly costs are about $60,000. Florence's Social Security benefit is $20,000 annually, which covers her basic expenses but not her long-term care. She also has $400,000 in an IRA and a life insurance policy with a long-term care rider who will pay $500,000 to Florence and her children upon her death. Alternatively, Florence could use up to $10,000 monthly for long-term care costs. Any amount used for long-term care, though, will reduce the insurance death benefit. Please note, that this is just an example and does not represent any specific policies. Many long-term care/life insurance policies these days work the same way. Now, suppose Florence is infirm for 5 years and uses her policy to pay for long-term care expenses. That's why she bought it, right? Here, Florence pays little or no income tax during this period because she'll have large unreimbursed medical expenses. The $500,000 policy pays out $300,000 or $60,000 annually for 5 years. That means her kids will inherit tax-free insurance of $200,000, the remainder of the $500,000 policy value. In addition, her children will receive $400,000 in her IRA, which will be taxable. Let's suppose that Florence lives for the same 5 years but uses her IRA to pay her long-term care expenses instead. Because her high medical expense deduction, Florence still pays the minimum annual income tax. Now, the kids are going to inherit the $500,000 life insurance completely tax-free and roughly $100,000 remaining in her IRA, which will be taxable. Comparing the scenarios, the ultimate net benefit is unknown because it depends upon Florence's children's tax rates. But it's hard to imagine a scenario where paying for care with $300,000 in taxable money with a minimal cost to Florence is not a better option than paying for her care with $300,000 in tax-free money. In the second scenario, we're preserving tax-free money for the heirs and paying for long-term care with Florence's taxable IRA money. Okay, we're getting towards the end here, and you're probably thinking, goodness, how in the world are we ever going to manage this? It's a good question. Let's start bringing this all together. We started out by clearly stating the problem, that retirees often pay more taxes than expected because of a confusing system that treats various income types differently and contains hidden taxes and penalties. Let's do a quick review of what we learned about the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding your savings, your after-tax value, before retirement. We also saw that in those pre-retirement years, it's critical to consider the tax-deferred savings and start taking advantage of funding Roth accounts to fill up your brackets, something you do through your early retirement years when your taxes are low. We also looked at Social Security and taxes. Medicare has its tax-like structure that can push you off the Medicare cliff. We also saw the importance of signing up for Medicare on time, right in the middle of your early go-go years. And we've seen that the importance of planning your income needs before it's taxed. That's because you'll be confronted with your required minimum distributions starting in your middle retirement years. And we've seen the importance of planning your income needs before then and the tax issues involved. Then we saw the importance of setting up your assets and managing them during your later years of retirement so you can preserve the most for your heirs and leave them the most tax flexibility. All these items together lead us to an obvious solution to the original problem. Because your tax exposure will change throughout retirement, you need a strategy that anticipates how and when to tap into your assets to cover your expenses, understands the range of taxes you'll face at various stages, manages your actions so you pay as low a tax rate as possible. By watching this presentation, it indicates that you're preparing to leave the accumulation phase, saving for retirement, and move to the distribution phase when you're starting to spend your retirement assets. Seeing that the distribution phase is more complicated than working and collecting a paycheck. Managing your tax rate through the 4 stages of retirement is part of the challenge of the retirement planning. Naturally, we want to be efficient in our savings, and there are strategies to reduce our tax burden. But as with all things in life, it takes education, planning, and a little advice. It's a lot to think about. Our tax code is complex and the rules keep changing. What doesn't change is the need to plan. I'd like to help you create a retirement tax planning strategy. This is a complimentary 1-hour service I offer. In the description or chat, you'll find a link to my calendar. We can schedule a one-on-one meeting to discuss your retirement and savings needs and the role taxes will play. During the meeting, we'll assess your and your family's current position regarding retirement preparation, review your timeline, and identify key retirement planning and tax issues you need to anticipate. After that meeting, we can be a resource and help you find the right people to assist you with specific tax advice. We can also help you with key financial planning and investment advice that applies to your situation. Regardless, when you leave our meeting, you'll be better informed about your retirement planning needs and what to consider doing next. We want you to be prepared and organized for this aspect of your life so that you and your family can have peace of mind knowing that you've got a plan for making the most out of your retirement accounts. Don't forget to grab the tax guide in the link below. Thank you for joining.